Seems like we're up and running. All right. So we had a request to talk about volume profiles, and there's a lot of different kinds, and depending on what broker you use, you may not be able to use them on all products. For an example, the SPX it doesn't have shares, so technically it doesn't have volume. And if you try to apply a volume profile to this, it won't work, at least on Thinkorswim. But if you go to TradingView or you go somewhere else, it will show volume. And I think what it's trying to do, since there really isn't any shares traded, is I think it's looking at something like the TPO profile on TradingView and using that as quote volume, even though TPO isn't volume, it's trades, all things considered. I mean, just to keep it as simple as we can keep it. So when it comes to volume profiles and TPO, the difference that I try to show people is, and this isn't like the textbook answers. So, if you go nerd out on it, you're going to say, Sig, you're wrong. It's not exact, but it's the easiest way to wrap your mind around it and keep them separate. TPO is how many trades took place at that price. And volume is how many shares were traded at that price. If you're new, that may sound like the same thing, but they're two different things, right? I can take one trade with 10 contracts. I can take 10 trades with one contract each. So you really want to know your platform. You want to know the tool you're using, what its limitations are. The setup is pretty much the same on all of them. They offer a few different choices. You might see me turning things on as we go. I was turning off every app I could turn off to try to make that thing render faster. Logging out of everything, and it didn't help, but it was worth a try. So the price per row, to understand that one, it's these blue sections here. How wide do we want each one? Now I'm on the SPX, and each one of these bars is a couple of points wide, right? It went from all the way up here to all the way down here. That's one bar. So that's really big. If we wanted to get a little more nuanced, tighten that up some, how much price do we want per row? If you say tick size, everything has a tick. If you're looking at equities, the tick is 1 penny because the SPY, Apple, Google, they move 1 penny at a time. So the tick would be 1 penny. But what if I'm trading something and I want to do a little customization? If I was on, for an example, the ES, and I don't want to use a full point, but I don't want to use a tick, I could choose custom and then put in whatever I want. So for the SPX, since it is big, we could go in and we could do something like 1.5 or 2, just trying to not overwhelm this thing. But we'll go to default 1. That's 1 point. Time per profile. Now, if you look at this, it's showing, come on, open up. It's showing places we haven't even been to today. So it's not looking at only today's price action. But what if I wanted to only look at today's price action? That's what it's asking me. How far do you want to look back? Now, some places will allow you to draw the starting point, which is really kind of awesome because then you can put a profile on anything, even just one candle. But other places like Thinkorswim, I can't use the drawing tool to define my profile. I've got to give it a time frame. So I could come in and tell it, no, just use today. or use everything that you can see on my chart, do only a particular week. So that's the question that it's asking here is how far back do you want to go? Let's just choose a day because this will help explain some of the errors and the handicap here. If I choose just today, well, what about yesterday? Maybe I want some of that information, but I don't want it mixed up with this information. Don't hesitate to add another profile. If you add another one, you can give it different commands. So instead of it being on the expansion, which will put it all the way to the right, tell it no expansion and then do 1 day at a time. But now, how many days do I want? How many profiles am I looking for? Well, a week ought to be good. So 5, I suppose. And it asks, hey, do you want a multiplier? So what the multiplier is for, what if I had chosen an hour, but I didn't want 1 hour? I wanted a 4 hour profile. I could set it to hour and then put the number 4 in there. And now I can get a 4 hour profile, which is nice, right? That way we can get a little more specific about how much we want. The reason I say it's a little broken is what if I wanted the 9:30 open to the 12:30 when we got into lunch? I can't specifically tell it where to start or where to stop or how much to use from the chart. It's just going to start counting back. That sucks. That's why some platforms like TradingView are nicer because you can just use the drawing tool and tell it exactly where you want to start and where you want to end. But, we work with what we have. So we'll set it back to 1. We'll put this back today. We want 5 profiles. And to differentiate these two, go into the globals here, which you might have missed that. These are the 3 opportunities that you can change. The input section, all of this stuff, the plots, and then the colors. So we'll change this. We'll make it really stand out. And the point of control, that way we can tell them apart. Well, now we've got the same profile on today as we do on the right side, but we also now have yesterday, the previous days, we got extras. And that way we can use the previous day's profiles information in today's trading. When it comes to these profiles, I was really excited when I first learned about these. And I was using today, really. I didn't even think about the previous days because, well, the previous day was done. What the hell do I care? As a new trader, my interest was what are we doing now? And how can this thing help me now? I didn't really even think about the previous days. But if you get into some textbooks, that's where they do the best work is looking at the kind of trading we had in previous trading sessions to try to identify where there could be opportunities today. Where's everybody hiding at? Where did they get in large? And if we go back to that area, can we expect them to have some trader's remorse? You can get into supply and demand and all that confusing language, but just try to focus on the idea that if it was heavily traded, it would have a high volume area. And if we go back to that high volume area, it's very likely you're going to see more trading again. That's just trader psychology, right? We don't have to call it support or resistance because that's making assumptions. But we can still attribute it to a key area, a high area of interest, and hold an expectation that if we get back in that zone, we're likely to see elevated trading volume again. Well, I don't know if better is the right word. You're not wrong. You definitely get more information. If you look at something with the profile that has Globex, you're going to get more information. In my opinion, that's better, 100%. But I can't tell you how many traders that I know that turn Globex off and completely ignore it. It drives me crazy. I'm like, why would you deliberately choose to ignore information that is right there and could help you? And they say, I don't need that. It's distracting. There's no value there. They use a lot of language like, well, it's the big dogs ain't trading. They didn't even get into the office until, like, all this excuses is what it sounds like to me. It's just a lot of excuses. So they don't use it. And even day traders that I know who don't trade futures but trade options, they would rather chart the SPX rather than the SPY, simply because the SPY has that overnight volume or that overnight trading. And they say the charts are broken, they're gappy, wicky, ugly, distracting, and they don't like it. It just seems a little OCD to me. I don't care. I want the info. There's really a lot of information there that can help you out in today's trading. Why would you turn that off? I wish I could say that they're not, you know, famous, profitable traders, but I mean, you guys ever heard of Al Brooks? He's a name, right? I mean, he's pretty popular guy. He turns it completely off. He doesn't have anything to do with the Globex whatsoever. He doesn't want it, right? And I'm not going to sit here and say that he's a fool or an idiot and he doesn't know what he's doing, because we all know he does, right? He knows what he's doing. He's been studying this stuff, longer than some of us have been alive. But the word I use is ignorant. To turn your back on data that you know is there just is ignorant. I don't even have a better term for it. I won't do it. So yeah, if you turn on a market that has Globex, you certainly get more information. But I don't know if it's better. What you want to focus on is, what is my goal, right? Because those guys that are ignoring it, that's their goal, and they can do, whatever they want to do. But what's my goal? And your goal probably is similar to mine. I want to know if we're going to hit anything, right? That's really what it comes down to. If we move up or down, are we going to hit anything? That way, I've got a better idea of where I should be getting out, if I should be even getting it at all. And to me, not getting in at all is really valuable. It's hard to quantify m- the benefit of a trade not taken. But if I can remove high risk trades, I'm better off. I know we all want to get trades and we're always looking for trades, but I'm not looking for trades. I'm looking for a reason to stay out of a trade, to let it go by, cuz I want good ones. So when I see an opportunity setting up, I'm looking at it to try to argue the lawyer's argument. Is it any good? Is it good enough? Should I take it? Is it higher risk? Should I wait for a better opportunity? Where would that opportunity be? So if I can avoid a trade, then this thing helped me out. Plus, even if you don't want to trade, if you can use it to confirm your analysis, then at least you know you're on the right track. Because we've all had those days where our analysis is just wrong. And it doesn't matter what we do, it's just wrong. You know, hey, at least tell me I'm wrong so I don't try to trade on it and then lose money. It happens. Usually when that happens, it's because news broke my thesis or my plan, and now we're doing something I wasn't prepared for, and I'm completely wrong. That's usually how it happens. But there's been days where I thought it was supposed to be bullish and it turned out bearish or vice versa. I mean, sure, those happen too, but most of the time, news breaks things. So everything we've been talking about so far applies whether it's a TPO or a volume profile. They look and they act completely the same. If somebody didn't tell you which one you were looking at, you would never know the difference. But when you set them side by side, they don't match because one is more about how many trades took place, and the other one is, well, how much volume was in those trades when they took place. So I like to put both of them on the screen, and then I, of course, keep them saved. One that we look at every morning is this one. And the distance that I'm measuring is a 5 day span in time. Now, I didn't turn on the styles, but it helps to try to do that to understand how many days are actually here, right? It's a 5 day trading period. And although there are people who start their days on something other than Monday, weirdos, I go ahead and I just start there, run it through Friday, and it does capture Sunday night. So, it's the whole trading week. I get a lot of value out of this by putting everything for that week together, especially if it's a broken week. Short weeks, holiday weeks, things like that, they really screw with volume profiles. But when you look at it for the whole week, it just takes everything and just sums it all up together. And I find that really helpful, especially the current week, right? If you're in a trading week that was a holiday week, that's when your profile is really broken. So jump out onto this time frame and look at all of the data for the entire week. That way it just puts everything together. And then of course if you add your lines, your levels, your drawings, uh, cog lines, the Nasdaq swag, all of the levels, they often will line up right with the profile, which gives you that extra conviction that your analysis is on track. Now, I've got this chart set at 65 minutes, but that's just me, right? You could use a 1 hour, 2 hour, 90 minute, it doesn't matter. The goal for this chart is to put all of the price into a 1 week profile. I only wanted this many candles, so I used the 65 minute. And that way, when I zoom out, I can see well over a month worth of weeks, right? Well over that. And I'm good. This is just about the right amount of weeks that I want to see. When you're putting your profile together to run your week profile, like I'm running here, think about how many candles you're actually going to get when you do that. And if those candles are going to be too big or too small. If it's a 15-minute chart, for an example, I wouldn't get as many weeks. I'd have way more candles, and it would just really mess up how much information I have. It would be more granular information, but this chart isn't about granularity. It's about the bigger picture, what happened on the whole week. And so I like the 65 minute, but there's no magic to 65. Play around with it, try to find something comfortable for you. Um, on Thinkorswim, you can mess with the color to turn it transparent. A lot of people don't realize that, but you can. And so if you have a hard time seeing the candles and you want them to kind of pop, make the profile more transparent so that you can see through it easier. Right. So the what you call spikes, we call the high volume nodes, or you might hear me sometimes call these shelves, like a shelf on the wall. A volume shelf, a volume node. Those are where in in this one, since it is TPO, Is it? No way. I jumped to my own saved chart. All right, this is a volume profile. This is where the most trading took place. For every trade that took place, it kept adding it to it, right? More volume, more volume, more volume. So does it have to be institution? No, not necessarily. But who else is going to put in, 75 million contracts in X amount of period of time? I mean, technically we could, right? If we had enough of us, but it's unrealistic. So it's attributed to them, even though, to be fair and to be honest, we never know if it's them. We always just say it's them. Well, when we say them, which them are we talking about? The broker dealers, the CTAs, the VC funds, Starbucks, right? Because Starbucks trades the ES futures for their coffee futures. It's how they hedge their coffee futures. Uh, is it, some farmer hedging his soybean with the ES? Who the heck knows, right? But it's very rarely attributed to retail. So you could say, yeah, that's them. But in reality, we would never know for sure. It's the anonymity that you expect as a trader, they get it too. They don't have to declare, hey, we're taking a trade. But it stands to reason that it was them. So in the shallow areas, we didn't count as many trades or as much volume. So those are low volume areas. And generally, what we say is price can move through shallow areas really quick because it was unobstructed. It was a shallow zone. We went from a high zone to another high zone, and we moved through it really easy without a lot of interference because there wasn't a lot of footprints left behind from previous trading. So shallow areas are areas where we expect price to move through pretty quick. When we get to another high volume node, I don't call them support and resistance because to me, those words don't fit in trading unless you're looking backwards and you say, oh, hey, that was support because you saw that it did support price. Or, yeah, that was resistance because it did resist price. But I tend to look forward, not backwards. And I want to think about what price could, should, or will do. And I don't like the word support and resistance in that context because until it resisted price, it wasn't resistance. It was potential resistance, potential support. Now, when you think about the levels that are here, there are three lines that are drawn by the indicator. Five, if you count the high and the low of the day, which some indicators will draw for you, right? So in technically you could get five lines. The one with the most importance, in my opinion, is the point of control. And that's the place where the greatest amount of trading volume took place in the time frame that we're measuring. So if we look at last week, the most trading volume happened at 66.91, which is a cog line, and that's the point of control. Well, it's actually for this week, not last week, but that's the point of control. That's the line I would want to carry forward. So if I look at last week, there's the point of control. That's the line that I want to carry forward. And depending on the platform that you use, it'll draw that line forward for you. TradingView's got a couple of those. And that's really nice because then you're not drawing it, it's just doing it for you. And this one is a VPOC. It's a virgin point of control because it has not been touched yet. I didn't name that, by the way. So, anybody salty about the naming here, I didn't do it. I didn't name the dead cat bounce either. Poor kitty cat. So that virgin point of control there, since we haven't hit it this week, it's considered a VPOC. This one from 2 weeks ago, it was a VPOC until we dropped down and we hit it on Friday. And then it was no longer a VPOC. You can get some of these that have been carried forward for a long time. And depending on whose chart you're looking at, you'll find these random lines that exist from a long time ago. But for me, this is the ES futures. And if you think about it, this point of control that I just marked is from contracts that are not even traded anymore. We are in a whole new contract, right? There's the contract change right here. It's one of the reasons that I like this weekly time frame. I can look and see, hey, did we change? Yeah, we're in the December series. So this can't be trapped traders, or it can't be, traders remorse if we happen to go back there, because they're not in those contracts anymore. Maybe they rolled into the new expiration, maybe not. And even if they did roll, they probably rolled up, right? Because these aren't options we're looking at, these are futures. And it's first in, first out. And whatever your new position happens to be, then that's your new position. So even if they did roll that, they would have rolled it somewhere up here, and their new position is somewhere up here, not down here. So I don't carry them forward once they expire. But if you're looking at Apple, Amazon, Google, SPY, you don't have contract changes like that, right? So you could carry those forward for decades if you wanted to. But just like anything else, the farther away in time, the less validity they have, and something closer in will probably have more value. So you can carry forward these points of control every day. In fact, the textbooks will tell you to carry them forward no matter if they've been touched or not every day. So the value area high, the value area low, and the point of control from yesterday, you should carry it forward into today's trading according to the textbooks. I don't. I've got enough pivot points that I don't need more. And so I just don't do it. But that's not to say that you shouldn't. If you want more clarity, you want more guidance, why not? Right? It's information, it's right there. We were just talking about how it's ignorant to turn our back on data when we know there's data available. The thing is, most of the time, those value area lines from a day to day basis are usually a line that I've already got. They're a point of control. They're, yesterday's high, yesterday's low, Globex high, Globex low. I just don't need them. So I turn them off. But that's what the books will tell you to do. So right now, what we've been looking at is just a volume profile. Here, we're looking at a volume profile in green and the TPO profile in blue. Now, because of the restrictions that Thinkorswim has, the volume profile looks back over all these days. The TPO is only looking at today. So that way, in the pre market, I can evaluate the kind of trading that we had in the overnight. What happened when Europe opened up, what was going on with Asia. And then where are we this morning? Around 7:45 or so. So it gives us a pretty good perspective of that overnight trading. But one of the reasons I use this 5 by 5 chart is to look at where we were yesterday and what the shape of these profiles are. Time, price, opportunity, TPO. In your mind, just think of the TPO as how many trades and the volume as how much volume. If you keep them separated like that in your mind, they're a lot easier to keep track of. Otherwise, if you go nerding out on them somewhere, right, and really get in on the weeds, it's technically not how many trades, but that is as the simplest way to explain it. And it's the way I always teach it, because that's how we can use it, right? If we start getting down into the weeds and gets all complicated and then people are like, I don't know what the hell to do with this thing. Just think of it as trades and you're good. That's how I think of it. One of the things that we do with these profiles is we consider the shape of the profile. You might have heard me say things like it's a classic D shape profile, like this day here was. If we don't look at price, but we just look at that profile, that's what it was, a classic D shape profile. But you can also get a double distribution profile. Now, if you've read the book Secrets of a Pivot Boss, and he talks about the initial balance and the six types of trading days, one of those trading days is a double distribution trading day. That's what the profile would look like if we happen to have had one of those. It looked like a capital B, but it's not a B. It's just two D's. It's a D stacked on top of another D. So double distribution day. There's also the capital P. So we got the D, the P, lowercase b, and then a double distribution. I made them into stickers. I think you guys can see those stickers if you look at the Discord, right? I don't, I'm not for sure, but here's the stickers button. Yeah, I had a little bit of fun, right? Making stickers. You got to do something to not play with the stop, right? So this is this is what I find to stop myself from playing with the stop. Animated stickers, regular stickers, one, two, three, four, five. I think the only one that isn't in here is the quote normal day. It seems to be the one that's missing. I don't know if I made a normal day. I guess not. Oh, yep, nope, just those five. But I've got the pictures, so let me just find the last one. I absolutely can post them later, but I'll tell you, I want to sneak out and go get on the motorcycle. So if I don't do it now, I'm really worried that I'll forget. And then what kind of jerk would I be that I tell you I'm going to do it later and then I forget and go get on the bike and you know what I mean? That just then you're hanging out waiting for some posts and I never post it. And you're like, that jerk lied. He ran off playing on the motorcycle. All right, there's the stickers. What you want to do is copy those, right? You can just pop them big, right click, copy image or save image, and download all of those. I got them off of the internet, so if you was to Google those, you'd find some variation of them. But I like these because it also has the range. It's not just this, it's also this, right? That's a really big part of the whole thing is what was the initial balance last night or today, depending on where you read initial balance, right? The other ones that I've seen on the internet, they don't all have that initial balance piece. So when I bring up this 5 by 5, one of the things that I'm trying to evaluate is, do we have a classic pattern or not? The D, P, lower B, double D. If we don't, we don't. It's okay, right? Like it doesn't have to give us a pattern, but having a pattern gives us a more technical analysis, right? Rather than just like, yeah, we got a bunch of levels from yesterday. Kind of janky, don't really have anything solid. Take our yesterday from yesterday. We had this level, and that one, and that one, and then the point of control. It was just distribution after distribution after distribution after distribution. Is it really helpful? I mean, to a point, yeah, but a classic D, B, or P has history behind it. It's been, studied and analyzed, and they've got all kinds of research on it. Um, a book that you're not necessarily a particular book, an author that you want to get a hold of is Jim Dalton. Jim Dalton is a real big deal in the footprint space, right? So if you're looking at like TPO charts, footprint charts, that guy is amazing. And one of the things that really comes down to using these sort of charts is how it integrates with footprint charts and TPO charts. So when it comes to those classic D's, B's, and P's, that ties in with TPO so much, and those footprint charts, you're definitely going to want his material because each one of those has a distinguishing characteristic that goes with it. Weak lows, strong lows, just it's really in depth. So thank you for that share, by the way, Rob. That's awesome. Um, dig into that. Now, I have never really dealt with Jim's material. I came across Jim by another guy named Peter Resnicek. Here on Think or Swim, you've got chat rooms. I don't know if you guys realize this, but it's got like a lounge, people hang out, right? It's got trading rooms. They're not very active anymore, but oh boy, they used to be. There used to be thousands of people in here all day, every day. And one of those channels was called I think it was called the Shadow Lounge or the Shadow Trader. Anyways, he worked at Think or Swim along with so many people. You'd be surprised at how many popular names out in social media worked here. But either way, um, Peter Resnicek talked about Jim Dalton all the time, and he does a pre-market analysis using TPO charts. And whenever he points out certain signals, he would always reference Jim and say, "Yeah, Jim says this," and So I've heard about Jim a lot. I've never really went through his material. I went through Peter's material. Second hand, third hand, whatever, it gets you there. By the way, it has this news channel. It's not bad. I mean, you got to kind of get used to being here, but um, Thinkorswim's just got so much stuff, right? It's so much stuff. That was a weird alert. Then there's this channel. Now, each of these three time frames, I use them for a specific purpose, right? And I've built these over the years to match my needs. The one thing I really want to highlight is there's no wrong way to go, and you don't have to do it the way I do it, especially if you're not trading futures. Because I know we got people here that just swing trade and they trade stocks and options. You don't have to do what I'm doing, but you want to consider the three time frames that I'm using and then adjust your time frames to something that works for you. We have the weekly one that captures the whole week. And then, I had what, 2.5 months worth of weeks showing. This works for me. It's a lot of weeks and the candles are just the right size. This is exactly what I want. And then we have this one, it's 10 days, 30-minute candles. It's exactly what I want. I wouldn't want it any other way, but I've grown used to this. I've used it for years. And to me, this is 10 days. That's 2 trading weeks, right? It's half a month. And that's usually a really good tell when things are changing. Was it a one off, a 1 day wonder? Are we, doing something different? 10 days is my sweet spot. So I like this. But if you're looking at something like Amazon or Google or Spy, 10 days may not be enough. You know what I mean? Because it's not going to have the same full amount of Globex candles. Sure, they got pre-market and after hours, but it's not running 23 hours a day. So, consider changing the time frames to meet your needs. The one on the right is TPO, the one on the left is volume profile. I like to look to see if they match because they don't always when it comes to where's the TPO, the point of control, where are the value areas, and then what do the tails look like? We haven't really gotten into that yet today, but how a low or how a high is formed really matters. Take this low from last week. I don't really like using this example because we ended the week and the day right there. It never had a chance to do anything else. But if this was just a regular day and not the end of the week, notice how there was nothing down here. It's not like you had sellers come down here and land into a bunch of buyers and then it rallied back out. There was no buyers. We just ran out of sellers. Now, true, the week ended, so that's a poor example, but we can scroll back and find another one. Take this high up here. We ran up into it, buyers are working their way up, and sellers landed on them with both feet and sent it down. I mean, look at that battle, all that volume up there, as opposed to this low. It don't look anything like this high. Sellers were in control. They ran it down here. They didn't run into a big pool of buyers and come ripping up out of there. We just ran out of sellers. And when we ran out of sellers, price went back up. So when it comes to drawing your own lines and levels, I've got my cog lines. Technically they're not mine, but we got the cogs. And then we got the typical lines, the high, low, close, Globex high, Globex low, today's open. All of those, I used to call those, quote, institutional pivots, but people kept misunderstanding that word institution to mean something like JP Morgan or Goldman Sachs or VC funds, because that's the institutions we generally mean. But what I meant by institutions was like, you know, a concept or a thought. These are our institutions, right? Like democracy and freedom, they are our institutions. So I don't call them institutional levels anymore. Instead, they're just your basic open, high, low, close levels, pivots. But beyond that, what about when you snap a fib and you got 111 and 1236 or the halfback? If if your levels line up with those high volume levels, then your analysis is showing the same answer from multiple sources. There's this really fancy word called multicollinearity. I first learned that word in psychology when they were talking about the echo chamber and peer pressure in social media. The idea behind it is a little bit like the Me Too or people that don't want to be wrong publicly. So rather than say something that may be wrong, they just don't say anything at all, or they only parrot what they've already heard. If your price action analysis is only coming from one tool, then you've only got one point of view. And everything else that you look at is just going to give you that one point of view. But what if you get the same answer from independent verified resources? Well, now you've got confluence. You've got the same answer from multiple sources. You got validation. It's very powerful. So I like the and word. It's yesterday's high, and it's an options level, and it's the zero gamma line, and it's the put wall. And if I can add 30 ands to the end of that, I love it. The more ands, the better, because it increases my conviction that I'm on the right track, or that that level has more focus. Because think about how many traders just use open, high, low, close, or how many traders just use options levels, or how many just, see what I mean? So each one of those groups might focus on 6,800 for their own reason. And yet, if I got 30 different groups all focused on the 6,800, that level's a hell of a lot more powerful. But it's also a volume profile line. So, and is a good thing. But these levels, this tool, I don't use it to take a trade. I really don't use indicators to trade. I just use them for analysis. So that at the end of my analysis, I'm more confident in the trade that I want to take because I have more information about the trade. And it's worth considering, is there any information there of value or not? And this is one that I struggled with for a long time because it seems like when you're new and people are doing technical analysis, they have an answer for everything. You throw a question at them and they're like, oh, yeah, no, it means this and it means that. And this pattern is this and that. And they never say, no, that's not a pattern. That's just trash. It's just noise. Don't worry about it. Or I don't know what that means. So I assumed when I was starting out that there was an answer for all of it. And that if you didn't know, it's just because you didn't have enough experience and knowledge yet. But a lot of indicators and a lot of patterns, they're not patterns, right? If there's no signal, there's just no signal. And you got to call it as no signal. If it's noise, it's noise. One thing to be mindful of is try not to draw your lines or your levels while you're looking at the profile, right? And it's not because you're cheating necessarily, it's because it'll trick you. You'll trick yourself. I like to draw my lines and levels and then turn on the profile to see if my lines and levels line up with the profile. But if I have the profile on and then I start drawing my lines and levels, inevitably I get lines and levels that I wouldn't have gotten without it. And that's not necessarily the same thing. I want to draw my lines, draw my levels, turn on the profile, and make sure that my lines and levels have some validity to them. If the profile adds more on top of that, great. I may take some lines from the profile too, but I don't want to start and finish with just the profile showing. Now, that's me. It's a handicap I have. And so, I'm trying to eliminate my own bias. If you can do it looking at the profile, well, goody for you. Do that. But I can't. I have to do one and then the other, or I don't get the same answer. So you're mentioning when all the indexes gapped. That's a really important thing to consider. I don't post it very much now, but back in the day, we used to talk about the four horses a lot. And of course, the four horses would be the ES, the NASDAQ, the Russell, the Dow. And we would watch all four of those in confluence all day long. We had a four grid chart. Pretty sure I still have that four grid. I think I'm looking in the wrong place. And it's a useful chart to keep up. It's just that the market changed and the divergence with the Dow is much bigger than it was. Same with the Russell. And so I don't use it as much now. But man, those four horses, we used to watch it quite a bit. Where I'm going with that is when they all push all at once, it's a powerful push because we are divergent a lot more than we used to be. So when they all sync up, that's crazy time. And we sync more. We have a greater market correlation in bear markets. That's a lot of fancy talk that just means when we're falling, eh, a lot more things fall in unison as opposed to when we're rising and then you get divergence. Like you'll get Apple today, but not Nvidia. And then tomorrow you'll get Nvidia, but not Apple. And then the next day they'll both be down, but Tesla's running. That's usually how good times go, right? That's your more typical bullish market. But man, when it's a red day, you'll get a lot more stuff falling, and that's a high correlation coefficient. Big fancy nerd talk there. I'm not seeing my full grid, but I got it, and I'm pretty sure it's in the Thinkorswim Discord as well. If you probably just search for the word horse, it should show up. And it was just a four grid, ES, NASDAQ. And I think we expanded it later and we added like the VIX and then we added, I don't know, like the dollar or maybe yields. And so four became six, became eight, and it started to get out of control. In fact, the chart we're looking at here now is what I replaced the four horses with over time. It's not the indexes at all. Well, down in the bottom, we got the advanced decline and cumulative tick, Mag 7, banks, and then the regular tick. But keeping your eye on those different markets is really helpful because, well, price doesn't move by itself. The four are the four indexes. So the S&P, the Nasdaq, the Dow, and the Russell. Let's see. At one point in the Discord, I had laid out a bunch of different charts for possible tradable setups. Some had the monkey bars on it. Some had the active trader on it. And you could just go through and kind of shop around and find what you were looking for. No horse. I haven't done a video on this for a while, but there was a video that I made as a live stream with you guys, meaning it was like one of these streams, and it was called What We Watch and Why. And I think it's still on YouTube somewhere. And the whole perspective behind that video was the intraday indicators that we look at on a day to day basis and these different charts, like the pairs chart here or growth versus value, right? All of these different ratio charts and momentum and flight to safety, they're all a part of a macro backdrop. Here's that four grid, by the way. No, that's Visa and MasterCard. Never mind. Futures grid. Aha. S&P, Nasdaq, Russell, Dow, the tick, and the ADS-PD. That's a real streamlined four horse chart right there. Colors are a little wild, but it gets the job done. Now, a while back, I mentioned how Market Gauge with Miss Schneider, how she has that little family ETF write up that she does, right? Like she's got like grandma, NASDAQ or whatever. I don't remember all the family members, but this chart is based on the names that she writes about: IYT, SMH, XRT, the whole grid. That way, when you read her email every night, you got the charts that go with the group that she's writing about. Anchor signal chart, if you guys haven't gotten into that yet, one is your anchor, your higher time frame. The other one is your signal, the smaller time frame. It's another way to distinguish between primary and secondary timeline. And then a bunch of Thinkorswim videos. So that channel is setting up Thinkorswim, all of these watch lists, trade charts, they're all in there. You can come up with a lot of really fun ideas on Thinkorswim to make your own ETFs. We were having a lot of fun with that over the years. The funny thing is nowadays people are making ETFs, real actual traded ETFs, so much that if you search around, you can just find ETFs like MAGS. MAGS is a fantastic ETF for the MAG 7. You don't want to trade those, right? They're for analysis, but still it's fantastic to have. So the four horsemen is a way to identify periods of time when everything is doing something at the same time. Because a lot of times in the current market, they're not, right? The Russell's dragging its feet or maybe even going down, the Dow's sideways, the Nasdaq's ripping like its butt's on fire, and the ES is chasing after it, just tripping on its own feet. But when they all start doing the same thing all at once, that should get your attention. Well, how do you know if they're all doing the same thing all at once if you're not looking at all four of them at once? Now, I built that one indicator for alerts to tell you they're all doing something at once, but seeing it is different. I know I got it in here. I just don't know what its name is. But we talked about that a couple of weeks ago, where I built an indicator that looks at tick, C tick, AD, weighted AD, UVol, DVol, and it looks at it for all of the indexes. And if they all line up bullish or they all line up bearish at once, it'll fire off. Yeah, that's what we used to do. In fact, in my office for a long time, I had a 48-inch TV and I kept that on that TV at all times. That way I could just look up at a glance and see where everything was. But I rearranged my office and I haven't put that TV back up. The thing is, if you don't have a lot of charts or a lot of screens, these charts can be cycled through. It's not like you got to sit there and stare at them, right? Or have a monitor for each chart. I cycle through a lot of these. That's why I keep them saved so that I can just push the button. It's there. It's always there. I never change it. And if I want to see these things, I push that button. I see these. And then I push another button and I'm back where I was. Right. And I love that so that I don't have to have a crazy amount of monitors. I used to run 6 connected to the desk, and then 7 if you count the big screen, 8 if you count the tablet that I had on my desk, 9 for the phone that I was glancing at from time to time. That's crazy amount of screens. Now I've got 4, and I rarely ever use the tablet or the phone, but just downsides. Cycle through the charts as needed. And if it's a day that looks like Monday, well, there's nothing to cycle through, anyways. That was just noise until it got to the edges and with really nice reversal. And then that was it. So the nice thing about those profiles is it can tell you where there should be traders. You can try to find them on the dome in the active trader. You should be able to see them in the queue, see them positioning, moving up, moving down, pulling and stacking, and responding around that level. And that way you get the confirmation as we come into that zone. But even beyond that, you get to make a plan in advance for, hey, what are we supposed to do when price gets there? Or what's our expectation when price gets there? You can add to this by putting on something like the floor pivots and the SNR levels, right? Because those are math. And you want to see if that math for today lines up with the actual trades from yesterday. It's another way to validate those levels. That's really cool. Thanks, Rob. All right. Let's log out, jump to paper. No thanks, Alexa. She's lonely. She's sitting right beside me, so she knows. I tell you, we use that Google around here a lot. Um, and it highlights more and more how broken Apple's system is. Don't get me wrong, I've got Apple phone, Apple Watch, Apple tablet. But that Siri is a fool and brings you links, not answers. You go and ask her questions like, "Look at this, look at this website I found. They address your problem or question or whatever. Maybe you should read that and see if that's what you're looking for." Like, I just wanted you to give me the answer, not give me a website where I can get the answer myself. Maybe. And it is not even smart enough to do simple tasks without screwing it all up, like sending a message or calling somebody or constructing an email reminding me of something. We're heavy users of the dot. So on Friday, we put a bunch of trades on right before the drop, and it was a little bit balanced, right? We were going through the Dow, not really paying particular attention to anything, just going from A to Z. We didn't get too far. We made it to the ends. Looks like we jumped a few. Actually, I think we made it to like cat. So we did those. And we already had Google, Intel, Meta, Nvidia. But when you're focused on a beta weighted portfolio, you're keeping your eye on your delta, and each new trade that gets added is all balanced on what do I need? Am I too heavy? Am I too light? Should I add some short deltas or some long deltas? And that way you don't have to worry about trying to protect your portfolio or defend it in a market downturn. You can see that no matter which way SPY goes, this would make money. As long as we don't just sit right in the middle, this thing would make money. Now, I didn't necessarily start from scratch here. In beta weighing, we already had a position on, and then we started talking about beta weighing and added all those on there. But how's the account doing since we didn't see this big drop coming, right? We weren't positioning for a fall last week. Looks like P&L since the open 275, P&L on the day 107.50. It's paper, right? So I mean, like who cares? I can get a paper coffee now. Woohoo. The highlight though is if that's how you were running your portfolio, you didn't just get wiped out when this market dropped over the weekend, because that's the beauty of running a balanced portfolio. And you can just keep adding and adding and adding and adding. And of course, as you roll and adjust and modify the positions, some of them become risk free and they don't even need your attention anymore. They can't lose. So then they just get, shuffled off to the side and you ignore them and focus on something else. And when we were adding these trades, all we were doing was looking at a daily chart. I think we had like 45 days on the chart, something like that, 3 months. And as long as it had decent options, we was just going from chart to chart to chart, putting on another trade. Now, if you're going to intraday trade, there's some tools available to make that a little bit easier. And one of them would be that active trader, especially if you're trading options. So let's go to SPY for a minute. And of course, in the live account, we can do the options chain here. I'm not sure it'll let us do it in paper. It looks like it. All right, so I've got 40 contracts showing, 40 strikes. And I can see the bid and the ask. I could probably add more columns. But how many contracts have been traded on just that one strike? What's their current bid and their ask? What has that strike done today? And if I was going to buy a call or a put, how many people are buying it with me? How many are selling out of the ones that they've already got? And where's the high volume nodes on that particular contract? I mean, that'd be pretty handy to know, right? You want a volume profile on that one contract. Well, there's a volume profile right here, but it's set to SPY. So if you hit the drop down menu, you've got choices across the top. We want options. And now we got another drop down, right? It's like this one, but it's down here. What options do you want? Well, we're looking at SPY. So let's look at SPY. And then hit enter. If you don't hit enter, you end up with what I just got, which was nothing. Hit enter so it'll load those. And now I've got the same thing that I have down here, but it's a choice now here. What do I want to do with this? Well, I want that 166 that's going to expire tomorrow. So I can see it's October 16, 2025, the 666 put. And it's just that one strike. Not this one either, this one. We'll tighten that back up just so we don't have so much stuff. 666, this one right here. Look at how many people are trying to sell it, how many people are trying to buy it, and the volume that's here. And where it was traded earlier today, high volume nodes, shallow areas. You got a lot more information now on that one contract that you're trying to trade. If I was on the live side rather than being on the paper side, it would probably have more numbers, right? Up to 10 on each side. It probably isn't showing me that because we're in paper, right? But so then if you go to get into a trade, you can now see what your position would be in relation to price. If I was going to go short, let's say I want to put, but I only want to get a put if we come back across that high. So I want to put somewhere up here. What's the price of that put? Let's see. Puts fall as price rises. So let's try to buy this put at 230 and see where that puts us. Oh, that's way too high, right? We're all the way up here. Well, I wouldn't get filled because I don't want price to go that high. I don't think price is going to go that high. I need it down here. So what if we get it for 240? That's a little closer. 250? Now, see, now we're getting there. Buying that put somewhere around 255 would be right about where I'd want to get it. Maybe a little more. 259. Let's try that. Yeah, we're settled right into that zone. Now I would fill my put right across that high, and that's exactly where I want to go short. You see how much more control you got over the situation? You can see what you're doing in relation to what price is doing. And if we wanted to, we could have a chart of that option. Now, I'm not a big fan of doing that myself. There's times, right, where you do want to chart that, but not always. So you could make, one of these charts on the side become your options chart, one of these quick charts. Here's that put. We can see that if I was to get this put, I'm buying it near the low of this range here. Not necessarily the low of the day, but the low of this zone. And that if it breaks down from here, we got a nice move. But a put losing price would mean the S&P rallying, right? So this would be inverse of what we thought the market was going to do. So you see how that can get confusing really quick, right? But we're trying to buy a put, and if that put makes money, then that means the S&P is falling. This would be the S&P low of the day, which would be the high of the put's value today. That's a nice target. Buy it for 280, 260, sell it somewhere around six and a half, $7. I already know what it could potentially be worth and not even be at the low of the day, which is good because now I can establish my risk to reward parameters and have a better idea of, is it even worth it? Is the juice worth the squeeze? Because if it ain't, why would I even bother? So consider how these volume profiles can help you out just by changing the product that you're looking at. I mean, we're still dealing with the S&P. We're just dealing with one particular put in the S&P. So once you're in, um, I don't know if I want to let this fill or not. I mean, it's paper, so who cares? But I want it to fill so that I can show you. You can put layer your exits on there too, so that you have a pretty good idea of what your exit price should be to match something like this 660 low. I mean, that's pretty handy if you're working a day job and you can't sit there and watch the chart all day. What's a fair price to sell this put? Seven and a half, probably be a fair price. That'd be near the low of the day. Well, how do we know that? Because it's over here. Seven and a half would be near the high of this, which would be the low of the day of the S&P. That's a fair price for an exit value. Risk two and a half to make seven and a half. Yeah. All right. I'm going to take that off of there. We had those trades on. So let's try to roll something. Um, I was supposed to get the cash account over here, and getting it over here isn't the issue. It's logging in over here. I checked my settings on the other account. When I log in under the other name, I lose everything. All my settings go to the other account. So I don't know how I'm going to solve that problem yet. But I still believe that we need to do actual real rolls on a real account and not paper. Because I think the paper is not giving it to us straight. Well, that P&L is really falling today, isn't it? Still in the green though. Hey, what's up, homie? We're playing around on Thinkorswim paper, talking about rolling. Hey, you run a beta weighted portfolio? So the now we're not talking about your trade account, right? We're talking about a longer term kind of buy and hold account. How do you keep that balanced or protected? Yeah, the thing about trying to run a hedge is say you got $100,000 in the market scattered across stocks, bonds, equities, options, you name it. But it's almost all pointed long in the market, like those kind of accounts usually are, right? So then they say, well, you should hedge that account. Well, one SPY call ain't going to cover my $100,000, and then how much of my 100,000 is even at risk? How far do we think the market's going to fall? A 5% pullback, a 10? How much damage will a 10% fall in the SPY do to my diversified portfolio? How many puts do I need? And that's why I think hedges are just a broken system and a broken way to go. Yeah. A lot of those a lot of those retirement accounts, they don't have a lot of capital on the side, to go in and deploy more capital for protection. So I generally keep a balanced portfolio to where every new trade I go to add, I first look and see, well, what do I need? Positive deltas, negative deltas. And then, okay, so I need, to sell some puts or buy some calls, or I need to sell some calls or buy some puts in something. And I can just shop around and find something. Yeah, a straddle or a strangle, as long as you have the capital to do it, right? That would be possible. And then how many straddles or strangles do you need, right? Depending on the size of the account and depending on how big of a pullback we think the broader market's going to get, right? That therein lies the rub because we never know how bad it's going to get, how long it's going to last, or if we have enough capital to deploy to get enough protection. And protection is not free, right? It's always cost, always. Yeah, we can, right? Institutions can't, but we can. We can play around with the options. But if you just run beta weighted all the time in your portfolio, I don't do it in my trade desk, no, but for the longer term account, every new trade you go to look at is like, well, what do I need? Oh, I need some, short deltas. Okay, well, go buy some puts or sell some calls. I mean, hell, we're selling calls all the time. That's no skin off my nose. Boy, yeah, that's bold. The thing about the out of the money calls or puts, right? Either one is you're right. That would be a lot cheaper. But if you don't fall far enough, fast enough, they won't monetize. So then, we could see a 8% drawdown in the S&P, but if you went too far out of the money, if you went too far out in time, if the fall was gradual and easy instead of violent and swift, that out of the money option isn't going to monetize at all. So now you're looking at a loss from the options you bought and you're looking at a loss from the account going down. It's a broken system. So, you know, uh, I was just curious, there's no wrong way to go, but every long-term trader I know has to have an answer to this. And most of them say, I don't have an answer to this. On Friday, we were throwing on like we used to do. We were just going down the list of the Dow, going into every new name that popped up. We were putting on trades, long, short, sideways. We put on all kinds of stuff Friday. And since Friday, the account is still up. It was up, and this is all paper, this is not real stuff. But um, the account was up 225, and on the day it's up $60. Now, that's not wow, but we didn't see this downturn coming when we were putting these on. We were just going down the list from A to Z, and every new name we came across, like, all right, well, let's see. Let's take a trade long here and short there and go sideways on this one. And not a lot of real technical analysis either. It was short and sweet, move on to the next one, like we used to do. Yeah. Remember the afternoon streams we used to do back in the day? Oh, yeah. Nerd sessions. So, what have you been up to? You're a champ, man. Can't even believe you're sitting at the trading desk right now. Man, scary stuff. Yeah, that is scary. Um, my brother's my brother's good. Oh yeah, I was gonna say my brother should be fine, unless you knew something I didn't know. Yeah, I'd stay on that rehab. Rehab sucks, but it works. It works. I had to learn to walk again. That is not fun. That was fast. Wow. I can't believe they were getting after it that fast. If I'd have done the damage to my hand now rather than 15 years ago, I probably would still have my hand. That's crazy. So it was just it was the Mountain Dew. Yeah. That would be my excuse. Like, no, it was just a Pepsi. Yeah, you got to laugh about it. I mean, what else can we do? What's your take on how everything is going? You think we're going to get a white uh Halloween, or we did last year, man, it like broke records for the amount of snow we got last year. And I'm in Kansas. You doing the Elvis thing? Huh. Well, it sounds like fun. I worked on those drilling rigs for most of my life. I'm not sure what you said. You're coming in really low. I'm sure it's my end. I had to turn Jeremy's volume up real high too. I'm sensitive to loud noises now, so I tend to have everything really low. But then I started turning it up when I realized you were talking, but I still couldn't really catch what you said. Yeah, throwing chain. I'm missing my pinky, and I took a lot of nerve damage in my ring finger and to the two knuckles on that part of the hand, the ring finger knuckle and the pinky knuckle, and then nerve damage up into my wrist. It was after that that I hurt my back and couldn't walk and had to do rehab to walk again. That's when I decided it's a young man's game. Or yeah. And I say it's a young man's game, but there were ladies that were working on the rig that had come down from Canada. Those ladies were showing them how to get it done. It's not bad when you're in the derrick 200 and something feet in the air. Get a bottle of bourbon out and just sit back and catch the pipe as it comes at you. What do you what do you think about anchored profiles? We didn't get into them today. I was going to go ahead and cover them Friday, but on TradingView, they give you the opportunity to, and on Tradeabate too, to anchor your volume profile rather than the default one like Thinkorswim has. Have you really nerded out on anchoring your profile anywhere specific? Yeah, like you know how you anchor the VWAP on big gap days or on new contracts or earnings or things like that, you can anchor your VWAP. Well, with the drawing tool of TradingView, you can anchor your profile. And there was a whole book on it I came across after reading Brian Shannon's Anchored VWAP book, which I can't remember the name of. I come across this other one that was talking about anchoring the profile, which is really cool. That's why I was saving it for Friday because I can't remember the name of the author and I was going to go get it. But yeah, it's just how the tools are adapting with the better software, and it gives us more granularity if we want it. Yeah, I'm a big fan of drawings. I think they're more of a money maker than indicators any day. And even just for understanding price action and having a better idea of what's supposed to happen. To me, drawings give you way more clarity. Let me open that up in the browser so people on the replay can see it. Yeah, I talked about that range this morning in the morning briefing too. That's my can't stay here pattern. I don't know what that's what I call it. I don't care where you go, you just can't stay here. It's yeah, you got to give it some time. Money don't grow on trees. I would I remember when my wife died and they brought her back from the dead and then she was in LTAC for 2.5 months. My head was scrambled for hell. Trading was bad. We were eating peanut butter for a while. Sitting in another city in the LTAC center, long term intensive care center, was in the middle of the hood. So they're like, well, we got to escort you to your car. We got to escort you here and escort you there. You can't just go wandering around. You're going to get mugged or robbed or you'll end up in the hospital. Like, yeah, you didn't think of maybe building this somewhere else? I couldn't think of anything. Yeah. It's hard to trade in when you got a lot going on like that. But you know that leads to a conversation that we've had before that if you've got a significant other, make sure she has access to the accounts because if anything happens to you, she needs to be able to at the bare minimum log in and shut trades down, just hit close on them or something. Yeah, me and Marzides talked about that before. Not a bad gig. Yeah, that's really what shocked me so much when I'm like, they say that this is smart money, and it's not to say that they're stupid because that doesn't apply. That's not the case, but they just don't know. And a lot of the stubborn ones say, I don't need it. What? Yeah. So earnings so far has come out pretty good with the banks. Something that is on my workload for the weekend is the military is going to start using those portable nuclear uh, power stations on the bases now, and that they're going to have civilian contractors as liaisons for they're going to provide the nuclear material and the civilians are going to run the equipment or maintain it or do whatever. There's got to be some trades in there, like I'm going to start digging into what companies are going to be on the line for this. Who's going to benefit, right? Quid pro quo. Yeah, that hit the tape this morning. I'd really like to I'd like to focus on companies that actually have products. You know, OKLO, it doesn't even have anything. Yeah, because who said it's a bubble? What? I was gonna say you have to put a little asterisk on there because there's plenty of companies that are monetizing it. Walmart went up today because they're monetizing it. You know what I mean? Like Walmart. That was an AI push today in Walmart. So there's companies that are making money and are benefiting. Yeah, but it has to come against the cost, right? That's where the asterisk comes in. Yeah, yeah, they are benefiting, but how much did it cost them to begin with? And have they even broke even yet? I saw a post yesterday that said NVIDIA got an upgrade from an analyst because of its 2027 projections. I'm like, dude, you already pulled in 2026. Now you're pulling in 2027. We're going to be bringing all these earnings so far forward that how much farther can you reach? Where was that post? I'll share with you guys. It wasn't like it was some Joe Schmo nobody either. I don't want to say it was Goldman because I don't think it was Goldman, but it was you know, a, a company of note. Yeah. And pulling forward 2027 NVIDIA earnings for an analyst upgrade in 2025. Um, I might have you one. Hold on just a second. Let me hit my notes because there's one that's not on the radar yet, and it is already picking up, but it hasn't been found. Where's my damn notes? There we are. All right, hold on. Um, to bring up these symbols. I'm gonna have to just kind of go down the list. There's ABT. No, no, never mind. Not ABT. Um, okay, well, we all seen the APLD, the data center headline, but that thing obviously is found. It's not that. I was just wanted to point it out. Um, those CRISPRs are coming back in again, like CRSP and that space. They're getting found again. If you're looking for an out of the way quantum, CCCX had a hell of a pullback. Obviously, it's hot, but that's a quantum play. Yep, they were hot today. Oh, I FOSL, fossil. HLIO? Who is HLIO? Oh, Helios. What is this? It's EV, isn't it? Or electric vehicle takeoff and landing group? No, that is not what it is. Energy. That don't look bad either. Ooh, no options. This this fossil one is on my radar. Um, it based for a year between 2023 and 2024, and it's just coming out of that base. It's like a mini Carvana type chart. I like this one. Now it's a little hot today. There's no reason to chase this, guys. It's gonna pull back, and you know, if we can get that new high, then we can get 10. And if we can get 10, we can get 20. You get 20, you get 40. You get 40, you get 80, you get 80, you get 100. Right? That's the way it works. But one thing at a time, right? Just getting to 5 would be fantastic. I'm looking at trying to pick this up around $2.50. So 100% move from 2.5 to 5. I like it. And it also doesn't have options. Well, I mean, it has options, but they are poor. So for my scans, they're not necessarily quote bullish bears scans. I have to go back to the live because paper is limited on Thinkorswim. Oh shoot, and it's after 4. Hey guys, let's wrap it up. Um, I don't know. I don't know what the scans are on that website, Austin. But if you are on the website, do me a favor, copy that web link and put it in the chat so that I can look at them. Because I don't even know what the scans are on the website, but I bet they need updated. But he's human too, and he gets busy. And it's been a while. I bet they were probably Creed's old ones. Could you imagine if they're Dan's? Are they that old? They need updated. Plus, I want to add mine on there anyways. So if yeah, you don't have to go hunting for it. I can go get it if you didn't. I just thought if you were already there, just copy the page and send me the link. So guys, on Friday we're going to talk about anchored volume profiles and the benefit of that, and then we're going to discuss how you what choices you have on where to anchor them. Consistency is something that I'm a big fan of. I don't want to just anchor it all willy nilly, right? I want to have very specific anchors and some pitfalls. I've learned that some of these anchor type approaches don't work on futures, like volume anchor for the ES. You would think new contracts or big gaps, something like that would be really good, but they're, they don't help at all. They're completely worthless. Now, if it's equities, that's fantastic stuff. But high volume, new contracts, big gaps. I've anchored VWAPs to the ES on all of those, and they were worthless. So, we'll talk about anchoring the volume profile and some pitfalls, and hopefully I'm gonna find the guy this really great book that I read on it, so you guys can check it out. I want to give credit where credit's due. Market Wizards. Oh yeah, 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 yeah. Oh, heck, absolutely. All right, guys. I'm trying to get as many rides as I can before winter hits because I'm a fair weather rider for sure. I don't go out when it's cold and rainy and nasty. Yeah, that'd be bad. Plus, just holding that bike up, it's a big heavy beast. Plus, with me and the wife and the bike, because I don't go out alone. She goes with me. All right, guys. Morning briefing. I will see you all there. You too.